Hey there, folks. Welcome to Iggy's Insight series, where we're diving deep into the economic mysteries that shape your wallet and the world around you. Today, we're tackling a topic that might sound a bit like wizardry: how banks create money out of thin air. Yes, you heard me right. Banks don't just store your cash in some dusty vault. They actually conjure up new money. Most people assume banks take your deposits and lend them out, like a big piggy bank with a lending window. But here's the twist. When a bank makes a loan, it creates brand new money that didn't exist before through a system called fractional reserve banking. This isn't some wild conspiracy. It's backed by solid evidence, like the Bank of England's own research showing banks create around 80% of our money as electronic deposits. So stick with me as we unpack 5 key insights to understand this mind-bending process and what it means for you, your finances, and the economy at large. Let's get started. Let's kick things off by shattering a big illusion about your bank deposits. You might think when you deposit your hard-earned cash, the bank keeps it safe, locked away until you need it. But that's not quite how it works. When you put money into a bank, you're essentially lending it to them. That deposit becomes a liability on their books. They owe it back to you. Here's where it gets interesting. The bank doesn't just sit on that cash. They keep only a small fraction as reserves and lend out the rest to other folks, business owners, home buyers, you name it. This is the heart of fractional reserve banking, and it's been around for centuries. Back in the 17th century, goldsmiths in England started this trick, issuing more receipts for gold than they had in their vaults, effectively creating money. Fast forward to today, and banks do the same with your deposits, but now it's all digital. This setup, though, comes with risks. Imagine everyone rushing to the bank at once to grab their money. A classic bank run. History gives us a stark example: the Great Depression in the 1930s. It all kicked off in 1929 when stock markets crashed and panic set in. People lined up outside banks, demanding their cash, but the banks didn't have enough on hand because most of it was lent out. By 1933, around 9,000 banks in the US had collapsed, wiping out people's savings overnight. Families lost everything: homes, businesses, dreams. It was such a disaster that the government stepped in with the Federal Deposit Insurance Corporation, or FDIC, in 1933, promising to insure deposits up to $250,000 per account today. That's why you don't see bank runs much anymore, at least not in places with strong safety nets. But think about it like a game of musical chairs. The bank creates more chairs, that's the money, than there are actual music, the reserves. As long as the music keeps playing and the economy stays stable, it's fine. But when the music stops, like in a crisis, there aren't enough chairs for everyone. Have you ever wondered what keeps this fragile dance going? Well, that's what we're digging into next. So, your bank deposit isn't what you thought. It's more like an IOU the bank uses to fuel its lending machine. Now let's get to the real magic trick: how banks create new money through lending. Picture this. You walk into your bank and ask for a $100 loan. If they approve it, they don't dip into someone else's savings to give it to you. Instead, they type $100 into your account and poof, new money is born. This isn't just moving cash around, it's creating fresh purchasing power out of thin air. Let's make it real. Say you're starting a small business, a bakery maybe, and you need $50,000 to buy ovens and mixers. You apply for a loan, the bank says yes, and suddenly your account shows $50,000 more. You write a check to the equipment supplier, they deposit it, and now their bank account grows by $50,000 too. The money supply just jumped by that amount, all because the bank hit a few keys on a computer. This process is a lot like how your credit card works. When you swipe your card to buy a new TV, the credit card company doesn't hand over cash you already have. It creates credit for you to spend, which you'll pay back later. Banks do the same with loans, creating new deposits that ripple through the economy. The Bank of England backs this up, saying about 80% of the money floating around is electronic deposits created this way, while only a tiny sliver, around 3%, is physical cash, like coins and bills. To see it on the bank's books, imagine before your $50,000 loan, they've got $500,000 in deposits and $450,000 in loans. Your loan adds $50,000 to both sides. Their assets grow with the loan they gave you, and their liabilities grow with the new deposit in your account. It balances out. but the economy now has $50,000 more to play with. That's pretty mind-blowing, right? But hold on, because this lending trick gets even wilder with something called the money multiplier effect. Now that we've seen how banks whip up new money with loans, let's talk about how that money multiplies across the system. In fractional reserve banking, there's this fascinating thing called the money multiplier effect. It's like a financial chain reaction. Here's how it works. When you deposit money, the bank keeps a fraction as reserves and lends out the rest. That loaned money gets spent and deposited somewhere else, and the process repeats, growing the money supply way beyond the original deposit. Let's break it down with an example. Say you deposit $100 in Bank A, and the reserve requirement, the amount they must keep, is 10%. Bank A holds on to $10 and lends out $90 to someone starting a food truck. That person spends the $90 on supplies, and the supplier deposits it in Bank B. Bank B keeps 10% of that $90, $9 as reserves, and lends out $81. This keeps going, and if you add it all up, that original $100 can balloon into $1,000 in the money supply. The formula is simple: 1 divided by the reserve ratio. With a 10% ratio, it's a multiplier of 10. But here's a curveball. Since March 2020, the U.S. Federal Reserve dropped the reserve requirement to 0% to help banks lend more during the COVID-19 chaos. On paper, that could mean an infinite multiplier, $100 turning into endless money. In reality, it's not that simple. Banks still need enough cash on hand for withdrawals, and they're bound by capital adequacy rules, meaning they must hold enough capital to cover potential loan defaults. Big banks love this flexibility. They can tap funding markets easily, but smaller ones might still keep voluntary reserves just in case. Back in the 2008 financial crisis, we saw how lending can spiral. Before the crash, banks handed out subprime mortgages like candy, multiplying money until the bubble burst, costing the U.S. economy trillions. So, the multiplier is a powerful engine, but it's not unchecked. Who keeps this engine in line? That's where central banks step in, and that's our next stop. So, the money supply can grow exponentially through this multiplier effect, but it doesn't run wild on its own. Central banks, like the Federal Reserve in the US or the European Central Bank, play a big role in managing how much money banks create. They've got a toolbox for this: interest rates, open market operations, and historically, reserve requirements. Let's start with interest rates. When the Fed lowers rates, borrowing gets cheaper, so people and businesses take out more loans, and banks create more money. Raise the rates, and lending slows, shrinking money creation. During the 2008 crisis, the Fed slashed rates to near zero and kept them there for years, trying to juice up the economy after the housing collapse. They also rolled out quantitative easing, buying up government bonds and mortgage-backed securities to pump cash into banks, hoping it'd trickle down to the rest of us. Then there's open market operations. If the Fed buys bonds from banks, it credits their accounts with fresh reserves, giving them more room to lend and create money. Sell bonds, and it sucks money out, tightening the reins. Back in the Great Depression, the Fed didn't act fast enough, and the money supply shrank by a third between 1929 and 1933, making the downturn worse. Today, they're more proactive, but not everyone's happy. After 2008, bailouts saved big banks like Goldman Sachs, while regular folks lost homes. Over 10 million foreclosures by some counts. Critics say central banks favor Wall Street over Main Street, widening inequality. The Fed even uses forward guidance, hinting at future rate moves, to shape market behavior. In 2021, they signaled low rates would stick around, keeping the money creation engine humming. But does this system really work for everyone? That's what some folks are questioning, and it leads us to our final point. Central banks are supposed to guard the economy, but trust in them isn't universal, especially when you look at the critiques and alternatives popping up. Some economists and thinkers argue fractional reserve banking is a recipe for trouble. Take the South Sea bubble in 1720. British investors poured money into a hyped-up trading company. Banks lent heavily, and when it crashed, the economy tanked. Fast forward to 2008, and we see a similar story. Too much lending, too little oversight, and a massive bust. Critics like Murray Rothbard, a big name in libertarian economics, say this system fuels booms and busts inflating prices and devaluing your savings. They push for full reserve banking instead. Banks would hold 100% of your deposits. No lending them out. No money creation. It'd kill bank runs dead since your cash would always be there, but it'd also choke credit. Businesses might struggle to borrow, slowing growth. Still, supporters argue it's safer, pointing to the 19th century Scottish free banking era, where banks held more reserves and crashes were rarer. Others want central banks to take full control of money creation, cutting commercial banks out of the game. Imagine the Fed issuing all money directly, every dollar tracked, no multiplier chaos. But the wild card here is digital currencies. Central bank digital currencies, or CBDCs, are already in play. China's testing its ECNY, and the European central banks eyeing a digital euro. These could let governments bypass banks, handing you digital cash straight from the source. Meanwhile, decentralized finance, or DeFi, on blockchains like Ethereum, lets people lend and borrow without banks at all, using smart contracts. In 2024, DeFi's total value locked hit over $100 billion, showing it's no small fry. These shifts could shrink banks' money-making magic, but they're not there yet. What do you think? Should we stick with the old system or try something new? It's a question worth pondering as we wrap up. We've cracked the code on how banks create money, folks. From the illusion of deposits to lending's magic trick, the multiplier effect, central bank oversight, and the push for alternatives. It's a system that's been around since those goldsmiths in the 1600s, evolving into the digital beast we know today. Understanding it puts you ahead of the curve, whether you're saving, investing, or just trying to make sense of the news. Back in 1720, the South Sea bubble showed us lending gone wild. In 2008, it was subprime madness. And today, with 0% reserves and digital currencies on the rise, we're at another crossroads. Watch things like debt levels. When household debt hits 80% of GDP, like it did pre-2008, it's a red flag. Check central bank moves too. Their rate hikes or cuts signal where money creation's headed. Now you're armed with the knowledge to see through the financial fog, ready for whatever's next, be it a crash, a boom, or a whole new system. If this deep dive sparked your curiosity, hit that like button and subscribe. Iggy's got more economic secrets coming your way. I hope you're enjoying this insight series by me. See you in Iggy's out.